So we're on slide 2. Moving on. So what the endeavor over here is to have a quick introductory session and a session which is going to focus on some basics of project finance with an emphasis on the Edureka course which is being offered on project and infrastructure financing, which is due to commence in the near future. And I offer participants a more deeper dive into this subject. So standing agenda items as such. First of all, I'll welcome you again for those people who've just recently joined us. We're seeing a trickle of people joining in. So an overview of project finance. This will give you kind of a high-level overview of the topics globally, and it'll look at some of the nuts and bolts of what go into project financing and some of the parties involved and the contractual structure, which is key to this kind of financing as such, and we'll see very shortly how that is. What we'll also try to do is pick out ways in which project finance is in some ways different to the other business lines or other forms of financing that you might have seen and other financial products. But actually, what we're also trying to do is and trying to find out ways in which it kind of overlaps with some of these other financial products so that we kind of draw off areas where project finance works and some of the other more familiar pieces of banking probably which you are already aware of or are working on. So I'll try to draw out similarities as well as differences, and that is where we're going to pick it up. All right. And also there's a quick note on when things go wrong, and sadly that has been the experience in recent years. And then we'll also look at some kind of current trends and issues. And if you have any questions, I'll be happy to have them either over the question box or at the end of the slides. So moving on quickly, what could be the basics here which we're trying to address. So in a nutshell, what is project finance and how is it different? So that's the key message which we're trying to relay out. And basically, so project finance is financing of big capital intensive projects, the big projects such as hospitals, roads, canals, ports, power projects, mining projects, oil and gas deals, and all such type of assets. They will come under the remit of project financing. So if you think of ways in which it's different from corporate finance or lending finance or acquisition finance, and basically in project finance situation, the borrower is a special purpose vehicle. So the SPV only owns one single asset, which is the project which is being financed. So if you contrast this with the corporate finance, you will likely be lending into the parent or a whole group of companies in corporate finance, which has numerous assets and has numerous business lines which are differing from each other. So in a corporate finance situation, you will be lending to the top level company or the holding company, whereas in terms of a project finance scenario, here in project finance, you're lending to a very special discrete vehicle which has a single asset which is being financed through this project finance mode. Moving on. So the other major difference with project finance is the way in which the lenders will be repaid. So it's typically from the money which is generated from the project. So if the project doesn't make money, then the lenders will not be repaid. So referring to a more practical context, if we talk about a power plant or a power project, it's the revenues that are going to be made from selling the power to the grid, and that is the money which will be used to repay the lenders. So it's very important from a lender's perspective to have a technical and economic evaluation of the money that the project is actually going to raise by way of, let's say, sale of power on the grid, or by tolls being raised for a toll project or a road project, or by way of sales of metal to an off-taker. So lenders and their advisors will need to be very clear about what the project would earn. And again, there the contrast with corporate or acquisition finance is that in a corporate finance situation, your team will be looking very much at the balance sheet of the group as a whole, rather than on a specific revenue stream, or rather at a very particular technical aspect of a project, and it will work, and whether it will work in future, make money, and finally repay the loans which you're lending out today. So that is the whole prospect. Now these projects can be quite capital intensive. As I said, I gave you some examples. These could be greenfield sites, enormous petrochemical plants, canal projects, or port projects. So they do involve a large element of construction and engineering that has to take place before the project is making any money. But this initial period which you see over here in the slide, so this is a risky period as there is no revenue which is being generated off the project, and it is a difficult period for the lenders as well, as you know this is a period which the banks would typically want to have at a bare minimum, keep it at a minimum, keep strict controls on what the costs are, how the spends are happening at this particular point, simply because there are no revenues which are generated at this stage. Now, there is a lengthy and complex legal documentation involved, and I'm sure most people on the call will feel that they have a lot of documentation in their office work currently, so this might not be a unique feature, but we'll cover that as well in the coming slides. So moving on to the through the parties involved, and if you see on the left hand side, these are the different lending parties. Down the middle, we have the sponsoring party and their contractors, and on the right hand side are the off takers and the government body. So these are typically the kind of parties which are involved in a project finance transaction. We'll overlay this slide with the contractual part of how this mode of financing works. We'll see that a usual project will have somewhere around 50 to 60 contracts signed between these parties, which is the key of this mode of financing. So breaking it down by the parties, so on the lending side, which is the right side, we typically have the commercial banks, but increasingly over the period of the last few years, a lot of these groups now have export credit agencies or ECAs in addition to the commercial bank syndicate, and that is particularly relevant in big structured products. So development banks are increasingly being involved, and all of their official lenders and commercial banks involved have a large agenda of their own. So each of these banks, these funding parties, have a different driver about what is important to them. On the legal side, you will very often see and you would very often have to deal with the different tensions between those differing aims and objectives of different lenders. Although all of them are providing money and financing, they have their own different objectives. So for example, World Bank has its own agenda, and an export credit agency which is probably funding has its own set of requirements. So these are kind of nuances which you face in this kind of financing. Again, on the lending side, we've got hedge providers, which we will come to a bit later in the course, and a unique point over here is mezzanine lenders, which have come in all sorts of shapes and sizes, which are increasingly relevant in the coming times. These are parties like private equity firms who are now getting involved in providing low-ranking debt. So mezzanine lenders over there. On the borrowing side, as we talked about in the project finance world, it's the project finance company, which is a special purpose vehicle, which can be sponsored by the government or ultimately held by a private sector company. So moving on to the supply side, so on this slide, what we're looking at is some of the contracts that the borrower or the project company will deal with. And as we said, they're very capital intensive, construction focused projects. So there'll be a number of contracts, as I mentioned, with construction companies, providers of equipments, providers of goods and services. So all these things are necessary to build the project. So there'll be separate contracts for that. And once the project is up and running, there'll be a number of contracts for dealing with the operational aspects, like perhaps the ongoing maintenance of a road. So O&M contracts will be there. So then we have the purchasers, which is again a key contract to ensure that the borrowers will be able to repay, as this is the person who's going to buy the output, buy the power from the power station, or buy the oil and gas from the plant, or buy the metal from the mine, or could be the government party as well that's given the concession agreement. So that's the purchaser which is going to give out money for the output. Again, on the right hand side, we have got the list of it's a long list of advisors who tend to get involved in these projects, legal being top of that list, but also very important is the technical advisors who can help determine whether the project is viable or not. Then we have the financial advisors, and increasingly banks like HSBC are often playing roles in putting the whole package of finance together. Then environmental, increasingly very important, and even model auditors to check that the financial model which is being put in place, it works. And on top of all of this, one important point to mention is insurance advisors, which is not listed here. They play, so the insurance advisors basically help in preparing an insurance package for the project, which will usually not be covered in the corporate umbrella policy. So you'll have the corporate's broker or the sponsor's broker interact with the lender's insurance advisor to draft out an appropriate package, which will also cover the interests of the lender. So insurance advisors could be added to the list. Coming to this, which is the contractual structure, which forms the basis of this kind of financing. So, moving on to the contractual structure, this is aiming to show you the different parties involved and the actual documents which are in place between the various parties, which end up being an enormous number, quite frankly. So, as I mentioned, it's around 50 to 60 contracts which are typical in any kind of project finance situation. So any infrastructure project, be it road building, be it power plant setup, will have around 50 to 60 different contracts. Some of these people on the call, I believe, would be familiar with some of these contracts, but for the benefit, I've listed down some major contracts in this slide. Now, you've got the key loan agreement between the banks and the project company, which we'll delve into slightly more details. And you have the security structure there. Then you have the hedging arrangements and the underlying contractual documents with the project contractors. And ultimately, you have the purchasing agreements with the purchasers of the output of the project. So that's how they are overlaid. Now, in a bit more detail, at the loan agreement, which is the key agreement, so lots of you on the call may be familiar with standalone loan agreements, and what we're trying to achieve is just to highlight some areas where project finance may be slightly different. So it's really the focus again on the more technical aspects of the project. So for example, you'll have your usual set of condition precedents with an additional requirement that all necessary licenses and permits are in place. You will have a condition precedent dealing with environmental issues, and going forward, if the borrower has the ability to make future drawdowns, each future drawdown will probably be tested by an independent expert, kind of an independent engineer, to confirm that it meets the technical requirements and that there are sufficient funds available for the borrower to complete the project. And one of the issues which we have noticed recently is that the projects have quite significant cost overruns. So it is important not to let future money out of the door if the project is not going to get completed with the funds available, and that is one of the key elements in the loan agreement which banks tend to look very carefully at. Then we have a small pointer on representation and warranties. I'll not get into that at this minute. Moving on, again with a technical focus, covenants, we have the usual package which we see in many different forms of lending, comprising financial ratios like net debt to EBITDA type ratios. But in a project finance scenario, quite frankly, the focus is on debt service coverage ratio, which is the second one in the list, also mentioned as the DSCR, which looks at the income which the project is going to generate over a period of time, and the debt service that the borrower has to pay out over the same period of time, and just to check that they are in a good enough alignment or ratio to each other. So that's the DSCR. I'll not go ahead and mention what are typical DSCR figures which banks look at. We could probably do that as part of the course when you join us, but just to give you an underlying score over there, the DSCR is one of the major things which most parties in this form of financing look at. Again, in the dividend scenario, financing parties will be very keen to limit the dividends that can be paid out by the SPV to its parents. So there are a number of conditions that are imposed on when the dividends can be made, and the key one is again that in risky construction phase, which is the starting phase or in the initial stage of the project, generally lenders would not want dividends to be paid out of the parent company. So they would want to keep the money locked up in the project company and control the borrower even after that risky construction period is over. So they'll control whether dividends can be made out only if the project is performing properly. Can the money be paid out? Else, it's kind of locked down in the company itself. So all of these are written in the covenants and form part of the loan agreement as such. Again, lenders will be very keen to know that the construction documents, other project contracts are going to stay in the form they have been approved initially, and they haven't been modified or changed except for some certain slight modifications. So there are significant ongoing reporting requirements to keep the lenders and their technical advisors fully up to date with the project progress. Generally, you'll have independent engineers who visit the site, perform their reports, submit their reports to the lenders, and so on and so forth. And ongoing environmental compliance requirements are of course there. And in the event of a default, a lot of this in a project finance situation is very similar to what you would see in other products in a bank. But again, it picks up some of the more technical aspects of the project, linking the events of default to the underlying project counterparties. So it could be the construction party or the offtake agreement. So if there's a default at the level, it could cause a default of the entire project as such. Uh, so you wouldn't want those key contractors to be replaced without the lenders having to have a say on that, and that's ensured through sections in the contract itself. Again, things like expropriation is a key thing in some of the jurisdictions. Thankfully, not so much in India where we operate. And abandonment is when the project is entirely abandoned. This will again trigger events of default. So moving on in terms of the security structure, just getting back again to some of the corporate lending activities, you may lend on the basis of the balance sheet and have a minimal security structure there. But in project finance, you tend to see just about all assets of the borrower that are connected to the project are secured in such a way that a security package is formed. So uh, in some jurisdictions, you would find that each different asset would have its own form of security documentation. So it covers all of the borrower's assets like real estate, inventories, equipments, licenses, the concessions that have been obtained, all the key contracts, and all the key documents that it has entered into. All of it, all of its bank accounts, the insurance policies which the company has or the SPV has, any kind of hedging arrangements which they have entered into, as well as any kind of charge of shares. So all during the risky construction period are being kind of pledged to the lending parties, would typically try and get a completion guarantee on top of all this from the sponsors, from the parents of the borrower, such as to ensure that it would use its fund and its efforts to completing the project on time and on budget. So all of that, along with the completion guarantee, ensures to a certain extent that the security package is well kind of watertight, and the lenders can draw comfort out of that. Now, a key point listed over there is direct agreements, which we won't get too much into details, but these are kind of direct contractual relationships which the financing parties put in place with key contractors. So, for example, the construction party and the offtake providers, uh, and they would have a direct agreement with the lenders such that the lenders have direct access to those contracts. Now, the key reason for this is and also with the very comprehensive security structure is that by and large, if you look at from the lender's point of view, so for the lender to get the project money repaid in a stressed or a difficult situation, when the project is in a is probably leading to bankruptcy, the only way probably they can get their money back is to have the project completed as it was originally planned, and then you can have the revenue stream kick in, and finally the payments being made out. So it's to get the project past that risky construction phase or that initial period when the project is getting built, and the security structure is put in place to enable the lender to step in and actually complete the project if they need to, or to sell it as a complete package to someone else who can complete it. So it's important to keep some of these key contracts in place as there may be a limited market for people who could provide such goods and services, and hence direct agreements with the financiers of the project. Okay, moving on, just looking quickly at the different forms of debt. I'm sure most of you on the call might have heard of all of this. So we'll touch upon the senior debt hedging liabilities. Ranking below it is the mezzanine debt, junior or subordinated debt, and the debt that comes from equities and equity investors by way of loans provided by way of equity in shares. And one of the key documents that governs these classes of debt is the Intercreditor Agreement. We'll get into that very soon. Okay, before I get into the Intercreditor Agreement, just a quick one. Any questions so far? Although we're going to take up the questions at the end of the hour, but if there's any pressing question, please feel free to ping me on the question box. None so far. Okay. I hope I'm not, although I'm taking prime time, I'm not getting any questions. I hope this does have some benefits to you in terms of an introduction to the topic. So moving to the slide, which is Intercreditor Agreements. So large value project finance, the Intercreditor Agreement becomes one of the most important documents, and particularly when things might go wrong in a project, it actually becomes the key document that everyone turns to. So what does this Intercreditor Agreement do? So it deals with the ranking of debt and securities. It deals with the ranking of creditors and talks about when they can act, when they cannot act, when they can start enforcing action, when they cannot do that. It also deals with the insolvency situations and how people are subordinated in that arrangement. And it deals with how you decide to enforce your security and how those proceeds might be allocated and changes to the parties. And also even simple things like amendments, waivers, which parties can do, which cannot, which creditors have a say in those various changes. All of that is listed in the Intercreditor Agreement. So, for example, you may not want to have a junior lender have significant amount of involvement in the more important issues of a project. You would not want to do that. You would like to restrict a junior lender to only to the basic issues. Chiming in, good news is that most of these agreements tend to come from their use in the US, and in the US, the subordination provisions are explicitly recognized in bankruptcy code, but that is not the case in all of the Americas. So in terms of Latin American jurisdictions, most of these provisions are not explicitly recognized. So that's something to be very careful in terms of how do you deal with them. So in the US, the intercreditor agreements tend to be quite strictly interpreted, and I would say to limit the subordination to what is explicitly provided for in the agreement is actually adhered to. So that's why one of the reasons why US intercreditor agreements tend to be very long is because the courts in the US tend not to imply rights in favor of senior creditors. And the last thing I would like to mention here is in connection to these agreements is that there isn't an important distinction actually available in the intercreditor agreement between a junior lender and a subordinate lender whose claims are contractually subordinate to the claims of a senior lender. So kind of first lien, second lien intercreditor agreements. So technically, if you see the second lien holders, their claims are not subordinate to the first lien claims, but their interests in the collateral is. So this is kind of a legal language, uh, but that is how it is. So the claims are not subordinate, but the interests in the collateral are, and this means and leads to a lot of confusion in terms of how courts interpret it. So we had a case recently called the momentous bankruptcy case, where some of these principles of the intercreditor agreement were interpreted in the courts in favor of the second lien holders. And unlike the subordinated creditors, the technical form of the intercreditor agreement for the first lien, second lien holders state that the second lien holder retains the rights as an unsecured creditor. So in the momentous case, that did not do much help. So it did a lot of damage to the first lien holders. So the rights the first lien holders thought that they had under the agreement in terms of preventing the second lien from interfering in exercising the remedies were actually not the case, and the courts ruled against them. So more on that in terms of the course, we'll lead on that. And I believe we have a question over here. Let me see. Just give me a second. So I have a question from Srinath, who says that he's from the solar background and he sees rare events in the project financing world, and any specific constraints for that. So Srinath, I have some direct experience in terms of dealing with the companies who are setting up these IPPs or independent power projects, and most of them, I think I've visited a couple of them in Jaisalmer. We have some in Tamil Nadu. A lot of them are focused in Gujarat. So I'm not sure which side of the table you sit in terms of whether you're sitting in terms of a person who is from the company or the SPV side, or from the lending side, or probably from the rating agency side, or from the bank side. So uh, the major issue which these companies in terms of solar power they face is uh, you need to get payments in time, and then that is where your cash flows start. It's like a pack of cards which start crumbling down. So if Tamil Nadu government is actually delinquent in terms of paying out what is due, so you have a power purchase agreement signed with the Tamil Nadu government. Let's say you have a power plant over there, and then your power plant is working at wonderful efficiencies. Let's say you have 22% efficiencies being drawn out of your solar panels. You're supplying to the grid, and you're expecting a payment at the end of the month, or probably at the end of the quarter, depending on the PPA. And finally, at the end of the quarter, you also have your interest and principal amount due to the banks, and you don't find that the payment has not materialized. There could be several reasons for that. Some kind of credit guarantees can be given, but it's again it's a slow system. So from what we have seen, Gujarat has been a state which has been the most efficient in terms of paying out to these IPPs and other companies. So I've had some talks with Wellspun and companies like that who have entered in, and even Mozambique who have set up some plants there. Uh, but by and far, that's the major problem. So if the cash doesn't come in, so as I mentioned in my previous slides, if the money does not start showing up on the door, the problem is that your cash flows are going to be strained. You'll not have money to repay to your borrowers, sorry, to your banks or to your other financial parties from which you raised financing, and that's the place where it all cracks down. All right, and we have Abhishek confirming that. Thanks for that. So moving on now to take a look at the overlap again between project finance and some of the other product areas. The senior debt provided by the banks for project financing is just one part of the debt package that needs to be put in place. The other part of financing, in order to raise enough money to build the project, needs to come from the equity side. So this is looking at the existing shareholders. So you may do a rights issue or provide shareholder loans, or look at involving new shareholders in the project, perhaps by way of capital market systems, or perhaps through convertible debt, uh, or providing a combination of other strategic investors who might actually provide funds. So one a recent trend is something called a standby equity distribution agreement. You might want to note that down. So that's the standby equity distribution agreement. It seems to be catching some kind of popularity these days. And then in addition to that, we'll touch upon the mezzanine lenders who provide debt, which is at a lower level to the senior debt, and they take a second ranking in securities. But then again, we have a lot of intercreditor issues which get involved, which I just mentioned previously. So these are two forms of debt. So in terms of mezzanine, I'll give you three categories. So we have the senior subordinate debt, the convertible subordinate debt, and preference shares, which are all forming a part of the mezzanine financing. So this basically fills the gap between the senior debt and the equity which is required. So moving on, commercial bank bridge arrangements and commercial bonds. The other type of lending products that you see around project finance are bridge loans that are made to project sponsors on a corporate basis to be able to begin construction or repay development costs. The idea being that the bank bridge loan would end up being taken out either by a non-recourse bank financing or through a project bond, which again I'll get to in a second. Important over here is mini perms. So mini perm lending just refers to the fact that many project finance loans, like many other bank loans, are relatively short tenor loans. So they'll have a kind of door to door of ranging from 5 to 8 years in terms of a mini perm. So this introduces refinancing risk, meaning that the project life in terms of repaying the debt is longer than the term of the financing. So the only way the project will be able to repay the mini perm at maturity is to go out and raise other financing to pay it out. So that's the risk inherent with the mini perm. Then again, we have two types of mini perms. I'll not get into that too much of a detail, but hard and soft mini perms and their own incentive structures. So moving on to project bonds. So these are making a comeback of late. They sort of arrived somewhere in the 90s and later had some kind of an upswing, and now they're back in the US and Latin America. So American bonds are covered under a regulation which is Rule 144A. Then you have again got some Regulation S which covers them. So they come under various security laws and exchange listing rules, and that's where they have some kind of underwriting disclosure requirements, which I'll not get into details right now over here, but just to give you a brief on that. So as is noted on the outlines, project bonds are often combined in what are called hybrid financing with bank finance, as there are not enough capacity in either markets to fund the loans. So in terms of capacity, the problem is that a lot of times you'd see that the project size and scale is to such a huge level that not a single bank or not even a consortium or a group of banks can probably do the lending all by itself, and that's where hybrid financing comes in the picture, and project bonds clubbed with the syndicated loan probably helps out. So then again, a number of intercreditor issues of course will arise because in part bond issues are typically pre-funded, whereas bank loans they are advanced out in the length of the construction period subsequent to the considered the way they are structured. So of course they have their own set of condition precedents, but it's still the lenders have a provision of stopping it out if they see that the project is entering rough territory, which is not the case with project bonds, which are wherein the money comes to the company on day one. Now, one interesting thing which I would like to point out over here is the rating agency issue around, uh, if an agency is rating the bonds, most of which are advanced in the early, typically upfront, as I said, are concerned that if there's a problem during the construction phase, the lenders, which is the banks, will not be obliged to lend simply by virtue of their condition precedent, thus leaving the bonds exposed to a potentially troubled project mid-construction. So one of the cures for this is to have something called as a true-up provision, so which the banks of course hate, whereby we agree that, and we do that in advance, that with certain exceptions, which typically include bankruptcy, that if there is a fault during the construction of the project, that they will nonetheless lend their part of the share with the bond proceeds, unless of course the creditor in pursuit of the intercreditor agreement agrees to exercise any kind of remedies. And even in that instance, in most cases, they would have to true up their commitments to the bondholders. So a true up provision is something which is a recent uptick in the market. It's although the bond market is very nascent in India, and is the case in most in the Middle East, it's picking up. The reason why it is picking up is because uh, I'll not delve into too much, but The primary reason for having bank financing go up on these project loans is because bank financing was quicker, it's easier to restructure, and it's easier to negotiate terms once the loan is sent out, which is not the case with project bonds, which tend to be more difficult in terms of costing. So it's more expensive to get out with a bond issue. It's much more difficult to negotiate terms with bondholders and so on and so forth. So restructuring becomes a big problem. But with provisions like true-up provisions, a lot of the risk which project bonds hold is actually gone away with or taken care of. Again, hedging and hedging termination payments are typically controversial in terms of their priority in the waterfall, in part because it's impossible to know in advance what the amount of hedge termination payment might be. So either a separate reserve is set up or a cap is imposed on a priority hedge termination payment. So, and in case of partial refinancing, you are going to have a number of issues regarding treatment of hedges and regarding remaining original bondholders or debt holders. So I'll just move on. Just one more point. So now in terms of hedging, most companies will have some kind of a hedging policy which will be put in place, which the parties agree upfront to the circumstances in which hedging is going to be put out. And then there are various issues to be considered again as to when the hedge is going to be closed out, and this needs to tie up with the project instructions and other lending agreements, and so on and so forth. So more on the hedging part in the course. Uh, but moving on, so hedge again is a very important part as such. So what are the other roles in project financing which a bank can play? So I mentioned some of them, but I'll again categorize them into two, which you see on the slide over here. One is corporate trustee role, and another is bank acting as an accounting bank. But uh, some of the other roles are, there is a facility agent and security agent role, and in that role, the banks will be very keen to know how they can enforce the security. So we talked about the security package and the things which get into that package in terms of real estate, so on and so forth, other inventories and so on and so forth. So uh, you may be taking securities in all sorts of jurisdictions. So it's important to know that the security trust deed is comfortable with what the security is being taken on board. Where is that security exactly located? What the process of enforcement is, and to check if the enforcement process actually works in practicality, what steps need to be taken, so on and so forth. All of this needs to be ascertained by the facility and security agent role, which some banks perform. And generally the provisions for corporate trustees are reasonably standard. So the trustees will be very concerned to include indemnities, very concerned to make sure that they aren't required to use their discretion without being indemnified, and with having the support of instructions from the whole lending group. And of course, the most important thing from the agency group is that they come at the top of the waterfall, and that their fees are being paid out at the top, and all the expenses, and there's no restriction in that regard. So that's the most important for corporate trustees. So you may also see that banks take on a role as an accounts bank. So in project financing transactions, there are numerous different sorts of accounts that need to be set up. Some we call here are the onshore accounts. So they have an international. So let's say you have a project in China, and you may have some accounts set up in the local Chinese jurisdiction. So these accounts will be used in yuan, or in the local currency, Chinese local currency, and they'll be used to make day in and day out operating transactions, meeting operating requirements of the projects. And you will then have a series of offshore accounts in perhaps London or in New York, and these accounts will have things like the DESRA account, which is mentioned over here. Typically, what it means is that the lending group may want to ensure that the borrower has, say, up to 6 months of debt service available in a separate reserve account, so that if things go wrong, they know that they have next 6 months of debt already covered in that account. You can have separate accounts for insurance proceeds from which it's paid out and paid into, separate accounts for disposal proceeds to be paid into, again equity deposit accounts, cost overrun accounts, so that would be a portion of money set across and blocked on day one that could be called upon if there's an approved cost overrun. And ultimately, you have the distribution account from which the borrower or the company or the SPV will be able to distribute dividends to its parents. So all of these accounts will be held with the accounting bank, and there's a project account agreement which is put in place that will direct the accounting bank how they can distribute funds between those various different accounts, and it will also list the kind of circumstances in which it can do so, and circumstances in which it cannot do so has some restrictions. All right, moving ahead. Okay, so we then turn to when things go wrong, and maybe a couple of war stories to touch upon here, and things actually go wrong, and more so in the recent times after the financial crisis. So a lot of us do spend some time restructuring project loans, and they don't differ much from a normal or other kind of loan restructuring or a corporate loans restructuring. So of course, there are more moving parts in the original financing, so it's slightly more complex. So one of the issues that comes up when you're working with the restructuring, or at least while you're trying to get a restructuring agreed or implemented, is the creditor, which is generally the holdout creditor. So now this is an important concept. So because technically you would see that payment terms which most need to be amended in terms of a restructure to give the troubled project company or the borrower some kind of a breathing room cannot be amended without having 100% consent. So that's the technical standpoint. And a lot of other project features, they can be modified or actually eliminated with some kind of majority voting, even when not all lenders agree 100% upfront. So, to stretch out principal payments or perhaps reduce interest rates, you typically would need everyone's concurrence. So I'll give you an example. Recently, we had a case where we had a relatively small lender to a project who backed out at the very end. It did not agree to a restructuring that the other lenders had agreed to. And so that was so what we did was effectively restructure the whole arrangement of contracts around this holdout lender. So the holdout lender still retained its original claims on its original terms and payment schedules on what it could do, and in terms of the local law, it could actually sue for payments for the installments of interest and principal due as they came on. But without the agreements of the other creditors, that creditor could not accelerate the loan or enforce security or do any kind of remediation actions. So what the other creditors did was that they amended everything they could by majority vote. And when it came to the payment terms and certain financial covenant, it was beyond a certain period of time, which required 100% vote. What they did was they kind of forebeared all the risk for the period of the restructuring, from the exercising of their rights to accelerating payments and enforcing the security. So effectively, what we did was we negotiated changes with the borrower, prevented the holdout lender from exercising remedies other than, of course, suing for payments past due. But obviously, in a distressed situation, again, as I said, it would be the intercreditor agreement, which would again become a key thing, and everyone would again turn to that. So these are some of the more recent things in terms of current trends and issues. One quick mention over here is I read a study which I think is a McKinsey study or a G20 study, which says that an estimated $1 trillion per year is required for all infrastructure development from per year up till 2020. So the problem here is who has got that much of money? Uh, it's only the pension funds and the insurance companies. From an ALM perspective, if you see, they match up with the way the cash flows are linked in a project finance situation. But most of these pension funds and insurance companies have very stringent portfolio regulations which limit their investments. So it has to be an investment grade. Most of the projects, like we have a friend from solar industry, will not be investment grade. Most of them will be BB minus or B plus. If you're lucky, triple B minus. I don't think you have many in that category as well. So at the moment, you would find that globally, if I talk about pension funds and insurance companies which perfectly align to the long tenure of a project financing deal, they only contribute about 0.5% to the entire funding requirement of this. So it's only about 0.5% of global portfolio which is contributed to infrastructure funds. They could do a lot more by taking it up, not by a huge amount, because we don't want to have incremental risk on these portfolios, but by a couple of percentage points. So that is there. The key hindrance over here is, as I'd say, inconsistent policies in terms of lack of regulations, which is a case. But then again, we need to have a pipeline of investable projects. By terms of investable projects, I would mean projects which are well constructed, risks are well allocated. So by way of well allocated, I would mean that the risks are given to counterparties or to parties of the contract which can actually bear it. So there's no point giving political risk to an SPV because it simply cannot be managed by them. So unless there is some kind of insurance provided by an ECA or a development bank for the political risk, there's no point giving out that kind of risk to an SPV because it would not be able to hedge it out. So these are things which need to be taken care of. If this is there, you would see that different funding would be required. So most of this funding probably is going to come from mini perms, as I said, project bonds, other structured products, and so on and so forth. So in a nutshell, those are the current trends. That's the demand supply, if you can so call, for this industry. And that gets us to the end of today's session. Before I delve more into the specifics of this course, any questions? I'll be delighted to have any questions from you. So if you, once again, if you have a question, you can type it out in the questions box and I'll read it out. Okay, there is a question which asks me, so kindly throw some more light on subordination on insolvency. I'm talking about the projects specifically for third-party buy-up with AAA rated private companies, but still the financing was based on balance sheet financing. Why Indian lenders are resisting in regard? In my limited knowledge, companies are raising in millions of dollars from companies abroad. Why Indian companies are resisting even when central government have included in priority list of lending? So is this pertaining to a specific kind of financing in terms of wind financing or renewable energy or power? Just a second. I'm having some difficulties getting to the question box. Okay, so this is for solar projects. Okay, the question is that he's talking about probably solar projects, and he's talking about third-party buy-ups with AAA rated private companies, but still financing is based on balance sheet rather than on the SPV. Now, a clear distinction, as I would say, if you are using project financing, is to have a separate entity created, which is a special purpose vehicle. So unless and until that entity is created, you would actually not call it strictly project finance. Now, and there are specific reasons as to why this is done. So, by definition, you would see that project finance is kind of limited recourse, if not no recourse funding. So the reason why we call it limited recourse is because in case a default were to happen on a corporate loan, Now, it would enable some kind of a recourse by the lenders to the assets of the company, but in case of a project funding or a project finance scenario, a lender's only recourse is to the assets of the SPV, which in turn are the cash flows which are going to come in. So if purchase is happening by a company which is a AAA rated company, bases their balance sheet strength of, let's say, an IPP, it typically is not a project finance kind of a transaction. The setup of the power plant which is being produced by was kind of a project finance transaction, if I can get myself clear on that. And I have one more question from Abhishek, which says, can you throw some light on subordination on insolvency? So I mentioned one example over here. So in terms of subordination, it's about how the jurisdiction wherein the company is, how do the law of land, how do the courts interpret that? So I gave an example of a company which is famously referred to as a momentous bankruptcy. This is very a couple of months back, if you go ahead and read on it. So what happened there was this kind of a first lien, second lien arrangement wherein, of course, the first lien holders are having priority over the claim of the assets as compared to the second lien holders. So the way it was interpreted is the intercreditor agreements between the SPV, the lenders, the first lien holders, and the second lien holders was typically almost same. So in a sense, what the courts said was that the interest of the first lien and second lien holders probably were subordinate to each other, but the priority of claims was not. So you could not say that I'll keep the second lien holders out of any kind of remediation proceeds. So if the first lien holders were to go and enforce their security rights, probably go and auction the project or sell off the assets, the courts ruled against them and said that you cannot leave the second lien holders out of such an arrangement just because their interest is subordinate. Their interest is, but their claims aren't. So that is where the intercreditor agreement becomes very important, and it goes ahead and specifies a list of assets and the list of bank accounts which are subordinate, which are not. So that's in terms of the insolvency. Any further questions, please? Okay, there's an interesting observation made that companies are raising millions of dollars from companies abroad. Why Indian companies are resisting, even when central government has included in the priority list of lending? Now, that's an interesting question. So it's not only that it's on the priorities list of lending and it's a priority sector. So I'll again revert to renewable energy, which is my favorite in terms of dealing with people who have set up wind power plants and solar plants. So if you see, now most of these, there are provisions which are provided. So the government will give you incentives like accelerated depreciation. So because of which, what you can do is, you'll have kind of people mushrooming small one or two wind turbines here and there wherever you have high wind velocity areas. So if you take, you take a round of Jaisalmer and the area around, you will find a lot of people, a lot of windmills across the main highway. The reason why that was done is people used to set up a wind power plant which was around, a wind turbine costs around 2.2 crores on a megawatt basis. So they would go and buy something from Suzlon, put up a power plant, and probably might not even use it for generating power. So they benefited out of things like accelerated depreciation. So all of that 2.2 crores would depreciate faster and thereby reduce most of their tax and profit before tax. So things like that. So there are other incentives which are put in place by central government, and there is a priority sector lending which the banks have been told to lend. The problem with banks is that even when you have a AAA rated company or AAA rated sovereign guarantee, if the payment from the off taker does not come, so if the discom, as I mentioned, Tamil Nadu discom or Madhya Pradesh, the discom does not give you the money at the stipulated time or at the planned time, you will have a problem of cash inflows. So you did have your power plant set up, you had all the things in place, you got your independent assessment of engineer done, all of it done. So your funding was proper, your quality was up to the mark, and you had the grid connectivities, all of that done, all agreements in place, and you finally make the first unit of power and sell it. If that unit does not get you any money, how much soever the central government has in terms of priority sector lending or whatnot, you would not be able to sustain this. And that is where the problem is. So as of now, if you see, banks are actually very wary of giving out any loans to big companies. So if you see a 7,000 crore road project between which is connecting between Gurgaon and Jaipur, which is the Pink City Expressway, even with all rights given out to them by around, they have around 11 banks in the syndicate or the consortium of banks. 11 banks, one of them is a private finance company. You have NHAI on one part, you have the government of India, which is having all policies to accelerate this and get this done as soon as possible. NHAI giving guarantees, still the highway is not getting constructed. The reason is not that the construction company or the SPV formed is not competent enough, or the government is not having the right attitude. Problem is that there are two places on the highway where right of way is not available. One of them has a temple which is required to be demolished. Public sentiment is there, religious sentiment is there. Even with NHAI giving right of way, it is not actually there on the ground. So things are not that simple in terms of Indian companies resisting. Of course, getting from from the international markets, it is a lot cheaper. So with the interest rates rock bottom, and we might have the Fed go up on the interest rates by year end. If that happens, it still is much lower to fund in terms of dollars. I know that there'll be hedging risks and all of that FX risk will be there, but that can be hedged out. So why should A, there is no appetite with Indian banks. B, they are very risk averse as of now. Third, their interest rates goes up if they do have to lend. So it has to be a consortium of things. It cannot be a single priority incentive which can get these project finance loans through to the end. So hope that answers your question. Any further questions, or I'll just quickly take you through. Okay. So if there are no further questions, so what we're planning to do is we are planning to start the batch by November first week, and the timings will be 8 a.m. to 10 a.m. So it will be 2 hours weekend batches. I've not shared the structure of the classes in this presentation, but it's available on the Edureka website. You'll have two case studies, which are the two projects which I mentioned over here. One of them will be a final project which tests you out on each of these contracts, on each of these relations, and so on and so forth. Okay. Yeah. And more so on this, I'm sure the person from Edureka will be able to contact, get in touch with you and probably get you, give you more details on this. But if you may have any questions on the slide, on the topic as such, you want to share any views, please let me know. By default, I know all of you are on mute mode, but if there's something which you would want to share, I can always unmute you. You can just send me a ping and I'll do so. All right, if no questions, we are almost at the top of the hour. Once again, thanks all for joining in, and hopefully we'll meet early November for these batches. Thanks all for joining in. I hope this was helpful. Signing off, Rohit Tuli once again. Thank you.